Welcome back to Next Gen Investing here on this Friday afternoon. It's under 30 time, and joining us now is George Tsilis, Senior Markets Correspondent for the Schwab Network. And George, happy Friday. Let's talk some SMCI. Not so happy of a Friday, I guess, for Supermicro investors. Yeah. This is one of the most incredible stocks in terms of its performance over the last year and a half that I can remember. I wasn't really, I guess, paying attention to the stock market when I was 8, 9 years old during the .com. But for those who want to make the parallels, George, accounting concerns, dramatic rallies, crash-like behavior, I mean, this is an example of some of that frothiness that's starting to show itself.
It is. I mean, look, the Supermicro, and also just to go back, I mean, during the .com bubble, there were a lot of companies like this that had tremendous growth opportunities, and then they were ensnared in accounting or even other types of SEC and even fraudulent accounting activities. WorldCom and Enron were just a couple of names going back to the late 90s, the early 2000s, prior to the bear market that essentially went through 2003. But I think if you consider the context of the market we're in, there's obviously a technological revolution going on. Companies like NVIDIA are obviously still continuing to the upside, but you're also seeing this poster child of a stock, a Supermicro, which is really indicative of this bubble froth that now has really just gotten decimated. I mean, in the last 6 months, the stock is down about, I think, 60 or 70%, as Jenny alluded to, down about 40+% over the last week. And it really comes down to, sustainability. And I think if you consider sustainability, you have to think about the technology. First off, obviously, NVIDIA has sustainable technology. They're a market leader. They have tremendous pricing power, and there's huge demand for their products. Now, if you look at Supermicro, their sales, just going back the last 4 quarters cumulatively compared to the previous years, they doubled their sales. Their products obviously are in high demand. But if you look at, and this is what I brought up, going back several months ago, if you consider some of the challenges this company faces, it's not necessarily a very large company. And 2, the technology itself is not necessarily unique. Liquid cooled server technologies have been around for quite some time. Essentially, they compete with bigger behemoth-based companies like Hewlett-Packard Enterprises, IBM, Dell. So the questions that I asked were, does this company's technology have preeminence above the rest? I didn't really think so. And then you add into the point of some accounting issues. Obviously, it's been selling off, and now the accounting questions have become even deeper to the point where Ernst & Young, which is their auditor, has basically declined to offer any services. They basically resigned and saying, we're not going to offer accounting services to you anymore. And that's a huge red flag right there. That's probably the first I've ever seen where a company essentially got ensnared in an accounting scandal and the auditor just pulled out their service completely. I don't even think Enron or WorldCom's accounting firms even bailed on them. So there's a lot of red flags here. I don't know all the details, obviously, but there's, like I said, a couple things that I noticed just going back several months. The technology didn't seem all that unique compared to competitors. And 2, I did also notice there was quite a bit of short interest for a stock that had run up, 10x in the past year, all the way through, February, March, earlier this year. But the short interest was around 9 or 10%. And now that I look at it in context, the short sellers knew something was going on. And right now also, by the way, the short interest has actually increased to about 17% of the free float.
George, that's exactly, we talked about this name almost a year ago, actually, like to the day. We started talking about it in the fall of last year. And the reason I even noticed it is because of the elevated short interest, because it was well before, the significant surge. So I totally agree with you there. And I think it's a good point to not say that, basically this week's sell-off is an overreaction. I think that maybe we were a bit too freely moving to the upside in this name. But now we have earnings next week, which I think the timing seems oddly suspicious. They're Tuesday after the close, which is, of course, the election day. I'm sure trying to bury it. So, are we seeing a lot of this pessimism priced in at these levels, or could we continue to see some risk as we go into what I can imagine is not going to be a great earnings event?
Well, here's the thing. Obviously they're selling and they're selling more products, and that's to be expected because of demand for their server technologies, which integrate, according to what I understand very well, with NVIDIA's ecosystem of GPU chips. So the top line is moving forward. The questions is how is that accounting being accounted for? And so there may be inventory mismatches, the way they're accounting or booking revenues in one quarter versus another. There's always some gray area of accounting where you could say that the accounting tactics used are legal but aggressive. I'm going to use Autodesk as an example. They actually got ensnared in some questionable accounting. There was an investigation, and they didn't restate any of their previous quarterly earnings. And so while the stock went down, valuations became very compelling. They didn't restate any earnings, and the stock since then was reiterated as a buy amongst multiple analysts and has moved higher. I think in this case, it's a little bit deeper than that because, the NASDAQ, they pulled their 10Q. They're not going to be essentially looking at providing guidance on any outcomes for earnings or sales. Analysts don't really know what to do with a company that doesn't have transparency. And then at the same time, your accounting firm bails on you. So, I could say, looking at it from a numerical standpoint, based on earnings, guidance, and revenues, which have really paused or halted, I can't really gauge any valuation metrics on this company. But there is a chance, and I suggest, there is quite a high chance that this company could revive itself based on its earnings, give us some additional information, and continue, moving back to the upside in some capacity. I don't think it's going to hit those levels we saw earlier in February this year, but in some capacity it could revive, especially with a lot of shorts now. There could be a short squeeze. And plus, the market capitalization of the stock has come down significantly.
Yeah, speaking of that market cap, it peaked out about $66.5 billion. Now, I don't know for sure, but I think the peak for Enron was around $70 billion. I hope that's the last we have to compare these two, just for the sake of investors. It doesn't go that path. Yeah. But, George, have a great weekend. Appreciate it, as always, senior markets correspondent for the Schwab Network.